Ladies and gentlemen, good day and welcome to Shri Keshav Cements and InfraLimited Q3 FY24 earnings conference call hosted by Kirin Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Vaishnavi Ambokar from Kirin Advisors. Thank you and over to you, ma'am.
Thank you. Good morning and thank you on behalf of Kirin Advisors. I welcome you all to the conference call of Shri Keshav Cements and InfraLimited. From the management side, we have Mr. Venkatesh Katwa, Chairman. Now I hand over the call to Mr. Venkatesh. Over to you, sir.
Yes. Good morning, everyone, and I welcome and thank you for joining the conference call for Shri Keshav Cement and InfraLimited. We are delighted to have each one of you here as we explore and discuss the financial performance of Q3 of financial year 2024. Before we dive into the details of this quarter, let me offer a brief overview of our company and its robust business model. Shri Keshav Cement and InfraLimited, formerly known as Concall Limited, is engaged in manufacture cement and solar power generation and distribution in the state of Karnataka. The cement plants are located at Bagalkot district in Karnataka and solar power plants are located at Koppal, also in Karnataka. The company supplies cement in North Karnataka, coastal Karnataka, Goa and some southern parts of Maharashtra. The company has a network of over 350 cement distributors, 600 retail sales points and 14 solar power consumers. Since April 2018, the company has been meeting 100% of its energy requirement through renewable solar generation. The cement plants of SKCL are likely to be the only ones in India running 100% on green power energy, resulting in nearly 75% to 80% reduction in the power cost. We are delighted to share positive updates regarding our ongoing capital expenditure plan aimed at expanding and modernizing our capacity. Anticipating the commencement of trial production that runs from approximately Q3 of this financial year, around July 2024, we are optimistic about the significant boost this will provide to our overall growth trajectory. Our commitment to excellence is reflected in recent accomplishments, like including recognition from Bureau of Indian Standards for maintaining the highest quality of cement without any product failures over the past 3 years of observation. Furthermore, our strategic capex initiatives combined with reduction in raw material prices and expansion of our solar capacity are aligning favorably, setting the stage for promising growth prospects for the remainder of FY24 and beyond. Also, we are very pleased to announce that the permission has been granted for our expansion of the solar plant from the current capacity of 37 megawatt to 40 megawatt peak, contributing to our commitment to sustainable practice and energy efficiency. These developments further solidify our position for continued success in the upcoming years. So in third quarter of FY24, our revenue from operations were primarily driven by cement business, constituting around 79.3% of the total. The remaining 20% originated from solar power generation, distribution and some other sources. The increase in both cement and solar capacity is set not only enhance our top line but also propel our profitability at an exponential rate. We want to reassure our stakeholders that our comprehensive strategies are firmly in place, ensuring impressive growth in the times ahead. Now let me take you through the performance of Q3 FY24. In the third quarter of FY24, Shri Keshav Cement and InfraLimited reported a total income of 34.36 crores. EBITDA witnessed an increase of 12.47%, reaching 11.69 crores, while the EBITDA margin expanded to 34.38%, making a substantial rise of 408 basis points. The company achieved a net profit of 3.97 crores, resulting in a net profit margin of 11.46%. accompanied by a notable increase of 748 basis points. Furthermore, the earnings per share stood at 2.52, demonstrating a remarkable growth of over 117%. These figures indicate a positive trajectory for the company's financial performance in the third quarter. As we anticipate the forthcoming fourth quarter, the optimism at Shri Keshav and InfraLimited is underpinned by a strong Q3 performance and strategic initiatives designed to secure a prominent position in the industry. The company's consistent growth and financial stability not only reflect past success, but also set the stage for continued prosperity in ever-evolving market landscape. In summary, SKSL emphasized notable improvements in margins during the third quarter of FY24. The company reported positive trends, including enhanced EBITDA margin and significant increase in net profit margin. These developments signal a positive trajectory for company's financial performance in the current quarter. So as we approach the question and answer session, I would like to convey my sincere gratitude to all our stakeholders. Your unwavering support and active involvement have been an integral to our growth journey, playing a crucial role in our success. We genuinely appreciate the significant contribution each one of you has made. So before I say thank you, one last word I would like to add. All the warrants that were issued in April to raise the funds under preferential allotment basis have been subscribed. So as of now, there are no outstanding warrants in the balance sheet. And once again, I thank you for your presence. And now I would like to open myself for question and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Yashwanti from Cogin Investment. Please go ahead.
Yeah, this is Yashwanti from Cogin Investment. Thank you so much for the opportunity and congratulations for a very good
Yashwanti ma'am, sorry to interrupt. Your voice is sounding soft. Can you speak loudly?
Yeah, can you hear me better?
Yes.
Little better, yeah.
Yeah. So congratulations, sir, for a very good set of numbers and thank you for the opportunity. I just have one question with regarding to our profitability and our revenue. This is a post-monsoon period where normally cement uptake we can see. So I just wanted to understand why our sales for the Q3 were at a flat as compared to the year-on-year growth. And secondly, we posted around a margin of around 34% plus. So what has contributed to the 34%? What has contributed from the operational efficiency and what has contributed from the softening of the raw material prices, as you mentioned in your opening remarks, and whether these margins are sustainable? Thank you, sir.
Sure. So your question is regarding the growth in Q3 as well as why was there enhanced profitability or EBITDA based on what impacted. So if you look at
a flat top line growth.
Correct. So typically when you look at the top line by itself, even though the growth has been almost flat, but dispatches have grown, and most of the dispatches what we have done in this quarter have been typically ex-plant basis, which means that normally the management of the company is trying to reduce the dispatches on the delivered basis and relying mainly on ex-plant basis. Now this will have specific advantage like the transportation cost is loaded onto the dealer, of course with certain discount on the pricing. Even though our quantity capacity utilization has reached 76%, because of the lower, not exactly lower net realization, because of to a large extent avoiding the transportation, the top line has appeared very flat, which is why you will see that your margins have increased drastically. In theory, if we were to do the same logistic like what we did in Q3 FY23, the top line would have been a little higher. But the main contributor to the profit margin and the EBITDA has been the reduction of prices in the petroleum coke. And that seemed to continue to go down for this quarter too. And hopefully, with that trajectory showing no, adverse price change, the profitability and the EBITDA is likely to continue in the positive direction. Thank you.
Can you please explain me this plant? Does it mean that you are directly dispatching it from the plant, something like that?
So what typically happens?
There are 15 parties in the conference.
So typically what happens is, when we dispatch cement to the end consumer, depending on the trade and commerce dealings, our competition what is going on, a lot of times we also offer to deliver it to their doorstep. Of course, there is an increased price realization with that, but not a lot of times the company may not realize the entire cost, or will not be able to pass on the cost of the logistics onto the consumer. But when we try to avoid more of delivering the goods to the customer, we eventually slowly get rid of the additional or incremental transportation cost, which is why you will see that even though sales has grown, in reality net realization also has grown, but it's still showing a top line flat because some of the logistic costs also have reduced.
Okay. So in the 34% plus margin, how much has been contributed from solar and what is the cement margin for you? If you can write a bit.
So are you talking about EBITDA?
Yes, sir.
So EBITDA has been a healthy growth this quarter. This quarter EBITDA is around 460 rupees. This was about 155 rupees in Q3 of FY23. This healthy growth is mainly because of reduction in fuel prices and is likely to continue. In fact, the entire last year, the cement EBITDA generated around only 60 rupees, entire year, whereas industry has achieved about 850 to 900 rupees. However, we achieved very less only because of inefficient utilization of fuel and power, which is what is being corrected in the capex now. So with 60 rupees the entire year, this year we are able to achieve 250 rupees for 9 months and almost 460 rupees per metric ton in Q3.
That is tremendous. And what about the solar EBITDA? What was the percentage over there? As we have also increased the solar.
Sure. So solar EBITDA typically is around about 33 to 34 crores over the entire year. So over the quarters, out of around 11.7 crores EBITDA, almost 8 crores is contributed by solar. The balance is contributed by cement.
So the enhancement in the EBITDA margin is because of very good EBITDA from the solar, cost efficiency, what we are seeing as with the petcoke price coming down, and also the strategies we played with the ex-plant deliveries. Am I understanding it correct, sir?
Yes. Mainly because of ex-plant delivery, the top line appears to have reduced in spite of increased dispatches only because to a large extent the logistic costs have been absorbed by the end customers. But EBITDA margin has increased drastically because of reduction of fuel cost. But there is no reduction in consumption. So there are two different things. Consumption has remained inefficient as it is. Even the power consumption is inefficient. But since the price of fuel has gone down, that has impacted the EBITDA. So this capex, what we will be doing, we will be addressing the issue of consumption itself.
Okay. So you say it is an under-consumption. So whatever it is the under-consumption, we cannot trade it with the bill?
No, I could not hear the question. Come again.
You said that there is this less consumption of the power. So I believe that is from whatever we generated from the solar that has been less consumed. Am I understanding it correct?
Correct. Even though we are consuming the power from our solar plant 100%, what inefficiently we are utilizing. For example, let's say we are consuming about 110 units per ton of cement, whereas industry has reached around 60 units. So with our capex, So ultimately, that 50 units, what we are consuming here, could have been better sold outside and generated profit, which is not happening right now.
The utilization is much higher as compared to the industry. I was thinking that other way that we are not able to sell it to the field. Okay, I understand.
Yeah. We are still able to sell it, but of course, we could sell more had we, had a very.
Yes, I understand.
Sure.
Yeah, I understand. When we recently increased our solar by around 2 megawatt, so what was the spend on it? And in future, like in FY25 or N26, do we have any plan to enhance it further? And if yes, what is the capex for it?
Solar, right?
Right.
So solar, as of now, we have 37 megawatt capacity. We, as we speak, we are adding another 3 megawatt. So final, paperwork to place order is going on. And the capex for this is around 8.5 to 9 crores, which will be contributed by the supplier by the way of long-term payment. So there is no cash outflow as such with this project right now. However, for the long term, once the capex of cement is completed and running smoothly, of course, company will look at adding solar capacity, which has been, the management has got a very good experience in setting up the power plants, and it has been showing to be a very good vertical. So yes, there are plans. As of now, no capacity or anything of that sort is finalized, but the management is on the way of adding more solar capacity after our cement plant has stabilized completely.
Okay. And even if we wanted to go for an expansion, I believe there won't be those incentives available which we had it initially. So I believe there are no incentives available on the government side. So we are going ahead without any incentives, but the demand is very high.
So even though there are no incentives available, if we have to sell the power outside, what is happening is once we expand or once this new 1 million ton commission happens in July, so existing power, what we are using, what we could have sold, we will start consuming it ourselves. So it will make sense to add another plant from which we will consume captively, for which the incentives do continue. Because for captive consumptions, there are no additional, cross-subsidy charges or other charges which otherwise would happen if we were to sell the power. So in that scenario, what would happen is the existing plant which still carries the incentives will, be free again to sell the power outside and, with, government-led incentives. And the new power plant or solar power project will be utilized to consume the power in-house.
Right. Okay. I think if you can just give me the outlook how the cement prices have been in the Karnataka for the quarter we concluded and the current scenario.
The pricing, as of now, it has softened a little bit in January, but still, typically pre-election, we would have expected a dip, but I don't see it happening so far. So January has been strong and till now it will be looking good. So I'm hoping that apart from a minor price correction, there's no significant change in the ensuing quarters.
Thank you so much, sir, and I'll join back in with you. And this is a very best for your coming quarter.
No, I could not get the again. Come again?
No, I said thank you so much for your explanation and answering your question. I wish all the best for the coming quarter.
Thank you, madam.
Thank you. Our next question is from the line of Ananya Swaminath from C Square. Please go ahead.
Hi, sir. Thanks for the opportunity. I wanted to know, despite the favorable post-monsoon season, our sales were flat compared to YOY. Can you explain on it?
You're talking about Q3, right?
Yes.
So there has been increase in the dispatches from 65,000 to around 69,000 tons in Q3. However, like I explained earlier, the net realization reduced not on account of reduction in prices, but on account of the company, reducing the, logistic expenses. So typically what used to happen in the past was say like for some percentage of the dispatches were done with delivery model, which means that the goods were delivered at the customer's point, by which the logistic cost was absorbed by the company. And, of course, you could not have transferred the entire 100% logistic cost to the customer. But now that has reduced, which means that the logistic cost has not added to our top line, which is why it appears to show that the realization has gone down. But in reality, the realization naked cement price has gone up, because of which, again, your EBITDA and profit margin also has gone up. So technically, even though it's looking flat, but we have also reduced the cost to a large extent in the logistic area.
Okay. And sir, how is our dealership network?
So dealership network is intact over almost 500 to 600 retail points. Q3 has been very robust. Q4 is already beginning, to continue that trajectory what we've seen in Q3. Technically, Q4 generally is little slower than Q3, but we have not seen any dip this quarter as of yet. And hopefully we'll continue with it strong. And our dealers network, we are, engaging in more, marketing activities. Eventually, when we have this new capacity online, we should be able to sell, 1 billion tons. So that's a preparation management is already involved in.
Okay. And how has been our working capital cycle?
Has been consistent. The inventory days also is in at par, and there's no significant change in either debtors or receivables. Everything has remained almost similar to what it has been previously.
Okay. And about expansion, on full utilization of our expanded capacity, what is the likely turnover we expect?
So let's say if at 80%, if you're talking about 1 million tons, so at with the inflationary trends, even if you get a realization of 5,000, you're talking about around 370 to 430 top line.
All right. So thank you so much, and all the very best.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask question. Our next question is from the line of Ritika Jain from HNI. Please go ahead.
Thank you for the opportunity.
Yes, ma'am.
Yeah. Sir, can you throw some light on funds deployment plan of recent fundraising?
Sure. So company successfully raised the funds, almost 46 crores from preference allotment, and balance crores we have raised through the bank. All together currently is being deployed towards, capex of this 1 million ton plan. So as of now, the company has, out of 80 crores, the company has drawn up 35 crores, but 45 crores is yet to be drawn. Since most of the payments happen to happen at the time of commissioning, next quarter, company will be drawing another 25 to 30 crores. So technically, the entire 125 crores, almost 100 crores will be utilized by the end of Q1 of FY25. That's how, it is looking so far. The prices have not escalated, so almost 90% of the projects have been placed, which means that there's no scope of any ill effects of any kind of price escalation. So based on what we had anticipated, the project is going extremely smooth and is expected to be commissioned on time.
Okay, sir, got it. Sir, where is the planned extension of solar capacity, and when can we expect this increase to be implemented?
So the first expansion of 3 megawatt, in fact, we are going to be placing the order in next week or so. So once that happens,
okay,
they already finalized on the supplier. So once that happens, our target is around April 2024. That is 3 months down the line, we should have come 3 megawatt.
Okay. Thank you so much, sir.
Sure. Thank you.
Thank you. Our next question is from the line of Himani from Suraj Enterprises. Please go ahead. Hello. Hello, ma'am.
Hello. Hi, good morning. Am I audible?
Yes, ma'am. Yes, ma'am.
Yeah. So my question is, your future growth strategies outlook for Q4 FY24. Can you provide insights into the specific benefits and impact we anticipate from expanding our solar plant capacity to 40 MWP, particularly in terms of subsidiary and energy efficiency?
Definitely. So you want to know the benefits on why we are expanding another 3 megawatt, right?
Yeah.
So first, the major advantage is the low capital cost because, the existing transformers, transmission lines, bulk of the almost 20 to 30% of the capital cost has already been incurred. So what we are typically doing is we are enhancing the DC capacity to accommodate the existing electrical equipment capacity. So with this low capital investment, the generation will be in proportion to the 3 megawatt what we will be adding, say about 40 to 45 lakh units per year. This will obviously mean that till we do the commissioning, this additional 40 lakh units will be sold in the open market, just like how we are doing right now, and additional revenue generated. And around with almost 45 lakh units, the company will add almost another about 2.5 crores EBITDA only by solar. So that's what we're looking at right now.
Okay. Thank you so much. That's it from my side.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask question. Our next question is from the line of Yashwanti from Cogin Investments. Please go ahead.
No, thank you so much once again for the opportunity. So I just want to understand, how is the demand scenario in the Karnataka? Are any major projects coming up in the infrastructure, and how you see?
There are 18 parties in the conference.
Hello.
Okay, those are cross-talk. So you were asking how the cement demand looking up, and are there any new capacity being added in the vicinity?
There are 18 parties in the conference.
There is a lot of disturbance. Can you be quick?
Sorry. I couldn't get the second question. I think there was some crosstalk, so I could not hear the second part. I can address the cement demand part.
Yes, that is what I'm asking. How the demand is coming up. So any major infrastructure or the housing project is coming up. There are a lot of stuff of the government on the infrastructure. So anything as planned for the Karnataka belt where we have our major...
There are 17 parties in the conference.
Could you hear my question, sir?
Yeah, now I could get a complete question. So this question. So typically, post-monsoon demand is always on the high, and Q3 and Q4 are generally Q3 and Q4 tend to be very good, with Q3 doing the best. So Q1 and then eventually continue to be Q1. So as of now, the cement demand is showing robust growth. We expected some dip due to ongoing elections, but luckily so far no such dip is observed. And typically in Karnataka, what we are noticing is some of the projects which had stopped immediately after the local election, they have picked up. So maybe expected to have a favorable opinion. So overall, the housing sector is intact. The government infrastructure spending is intact. In fact, we have seen cement price softening very heavily on other parts of India. On our side too, there has been some correction, but it doesn't look like it will be such a major correction what we have seen other places. So yes, the cement demand is robust as of now, and is expected to continue in Q4 too. And at the same time, the price of fuel also has been reducing. So it appears to be a good quarter so far.
So, do you expect the prices to remain under pressure for some more time as compared to the other part of the country?
Do I expect what?
The cement prices to be under pressure in Karnataka as compared to the other part of the country?
To a lesser extent, not to that extent what other parts of the country have seen. Somehow there has been some corrections, but not significant to impact any kind of bottom line significantly. So whatever correction is happening is commensurate with the corrections in the cost of fuel. So overall, I don't see a significant impact or any kind of negative impact happening in Carnatic region. We have not seen that, in short.
No. My question is, do you expect this the lower cement price to persist even for a few more periods, a few more months?
Yes, this quarter, whatever we have seen so far, it will continue this quarter. But it is not significant, is what I mentioned. So most likely, even if there is a dip, it is going to be happening till election and maybe a quarter after elections. But as of now, we have not seen that pressure happening here, not significantly. And I don't expect it to be there any severe pressure happening this quarter either. By now, if it had to happen, it should have happened by now.
Okay. So you expect it will remain moreover at the same level for the current quarter, slightly expected to improve in the first quarter of the next year, but then the next quarter will be the monsoon play, right, sir?
Correct. So Q3 was a good quarter. Q4, a little correction, not significant as expected. And again, Q1 final year will be similar to Q4. And then, of course, Q2 of next year is going to be a monsoon quarter.
Okay, sir. Okay, sir. Thank you so much for explaining.
Sure. Thank you.
Thank you. Our next question is from the line of Prathamesh Diwahar from Tiger Asset. Please go ahead.
I just wanted to know on the volume side, can you give us how much our volumes has grown YOY for the quarter?
So, volume-wise, for 9 months, we have grown only 2%. And we will be expecting to, touch at least 5% growth in volumes for the year end. That is mainly because we lost significantly on Q1 and Q2. So Q3 this year has been our 76% utilization, and Q4, could be a little better based on what is happening so far. So technically, in FY23, there are 226,000 tons was the dispatch quantity, and we have already reached 198,000 for 9 months, and or up to January. So we will be expecting in the range of 240 to 245,000 tons for FY24.
Okay. And so I think in your last call you told you are going to plan to entering into new markets like Pune and Bangalore. So any update on that?
So we would not be encouraged to look at that so immediately because, once the commission happens or trial production happens in July, August, maybe in the Q1 of next financial year, we will begin to look at outside markets like Pune, Bangalore, and other areas. So right now, the only planning is going on. So as of now, no actionable work has been done.
Okay. And so after post our 1 million ton expansion, how are we looking at the revenue or the volume guidance for FY25? And what will be the EBITDA per ton? Like I told you also invest doing capex in the energy thing.
Sure. So our luckily EBITDA for this year has grown from 60 last year to 250 rupees for 9 months for 9 month period, and 460 rupees per ton of cement EBITDA only for Q3. So this year is going to be in the same range like what we see 400 to 500 range, because unless there is an increase in fuel price, we are expecting to keep this EBITDA range. But once the expansion happens, we're expecting around 800 to 1,000 rupees EBITDA, just like other cement plants. So taking that into account, assuming that first half year goes with the old EBITDA and the next half year goes with the new EBITDA, on average, we're expecting an EBITDA of around 600 to 650 rupees per ton. With that, at around 50% or 55% capacity utilization of the full capacity, we are talking of EBITDA around 65 to 70 to 75 crores. and EBITDA per ton to be in the range of 650 rupees per metric ton. But the next year, when we have the entire new capacity with the new fuel consumption pattern, we are expecting the EBITDA to reach around 900,000 rupees, or maybe even better, because the current prices have fuel prices have come down. So at least 1,000 rupees is what we are safely targeting, assuming the same prices will continue.
Okay. Sir, sorry if I didn't understood it earlier. Like, I want to know on the sales front. So the major reason for the volume, for the revenue, slight revenue was because of volumes, right?
Yes.
Right. Okay. Thank you, sir. That's it from my side, and all the best.
Thank you. Thank you very much.
Thank you. Our next question is from the line of Urmi from Robo Capital. Please go ahead.
Hello, good morning. Am I audible?
Yes, ma'am.
Yes, Urmi.
I just wanted to ask, what are the utilization levels you are looking for FY26?
So based on projections, standard, we have taken around 65% in FY26 and around 70% FY27 onwards. So FY25, we are targeting around 50 to 55% on the whole capacity. So around 500 to 550,000 tons sales is what we have targeted next financial year.
Okay. I just wanted to clear that in the previous calls, you said that you would be able to sell the full capacity of 1 million tons. Is that achievable by FY26?
No, there must be some misunderstanding, because our projections, we have put it at 50 to 55% next financial year, and 65% in the following financial year, and around 70% after that. So cement plants in India operate at around, on average, about 75 to 80% capacity all over India. So for projection's sake, we are targeting about 75 to 80% 2-3 years down the line.
Okay. Thank you.
Because market is always going to be bad, and the capacities are designed based on almost 330 days working, 24 hours sunny.
Okay. Thank you.
Sure.
Thank you. Our next question is from the line of Manan, an individual investor. Please go ahead.
Thank you for taking my question. And congratulations on the good set of numbers, sir. I just want to understand that once our expansion is done, right, so will we have to market for our products, or like that 1 million ton of capacity which we'll be generating is there enough of the demand in the market so that the supply will be done easily?
Absolutely, Manan. So in the areas that we are located in, there's in the vicinity of just about 250 kilometers, I think almost 10 to 15 million tons of cement is being sold per month. So I think so, the capacity of 1 million ton is still minuscule in cement standards. For a small plant like ours, it should not be a major challenge at all. If we had about maybe 2 million or 5 million ton capacity, there is certain need to worry, because cement is one product where you cannot sell it very far off from the manufacturing location because of low value to weight, kind of product. But yes, to answer your question, management is very confident that we will be able to deploy 80% or 90% of our capacity without very, very significant efforts. Of course, we have to increase our market base, we have to increase our geographical area, but that is all it takes. Otherwise, cement consumption is poised to grow in the country. By 2028, almost 800 tons is expected to be the rated capacity, with current about 450 to 500 million tons. So 300 million tons is expected to be added in next 4 to 5 years. And 1 million ton should not be a significant capacity for us to sell.
Okay. And the second question would be that now, as you just said, we are doing on the explant model basis, right? So are we going to continue this with the explant model, or we might shift to delivery model again?
It typically depends on the market sentiment. So if it is typically a buyer's market, then we have to provide this extra services of delivery. But it is even if we do the delivery, we recover most of the cost in the pricing. Of course, not all the costs. So management is trying to push as much as possible where explant is possible. So it all, to answer your question, that is the direction where management wants to go, but eventually it depends on how the consumer, wants it to be delivered.
Okay, understood.
But overall, our net realization will continue to improve. Then what we know as naked cement, value.
Okay. And can you please give the production and sales volume for this quarter, third quarter?
So sale volume is 68,610 tons compared to 65,000 tons in FY23 Q3. You want only the cement sales?
Yeah, the cement sales volume.
And cement sales, okay, let me just pull up that figure. Out of almost 80% has come from cement sales. So let's say approximately 34 into 0.79. So around 27 crores has come from cement sales and balance coming from solar and some other minor other income.
Okay, understood. And as we had, in the previous con call, the company guided for around 300 something odd crores for FY27. So is that achievable? Are we still on that same track?
Absolutely achievable. For FY27, yes, definitely achievable.
Okay, sure. Thank you so much. That's it from my end.
Thank you. Our next question is from the line of Prathamesh Diwar from Tiger Asset. Please go ahead.
Yeah, sir, just a follow-up. I think you told about 600 rupees of EBITDA per ton. So is it for the FY25?
Yes.
Okay, and the 900 will be after expansion for FY26? Okay.
I average it basically. So currently it is about, say for the first half year it is going to be around 450 rupees, and the next half year it is going to be around 950 rupees, average to 650 rupees. And next financial year, which is FY26, we are targeting 900 to 1,000 rupees directly. Because by then the entire plant would be new, the fuel and power efficiency which would have been achieved.
Okay. And sir, the 300 crores guidance for FY27 that you have given, will it be achievable from that 1 million capacity, or will you be increasing more, or any plans for that?
I think it is a conservative estimate that we have done. So let's say at 1 million ton, even at 65% production FY27, we're talking about 65% also if we take this thing at around, so it is still showing about 330 to 340 crores top line. So we have given you the most conservative estimates.
Got it, sir. Great. Thank you, sir. Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I now end the conference over to Mr. Vaishnavi Ambogar for closing comments.
InfraLimited. If you have any queries, you can write us at research@kirinadvisors.com. Once again, thank you everyone for joining the conference call. Thank you.
Yeah. Thank you. Bye-bye.
Thank you. On behalf of Kirin Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.